Hello, good evening, everyone. Welcome to today's stream. Right, so great to have you guys joining in, and of course, appreciate that you decided to take time off over the weekend and joining in on a Saturday evening. Okay, so what I'll be doing here is to really share with you the approach that I use to analyze and trade the market. And the topic over here will be breaking it into two parts, right? First one is going to be talking about the direction. So today's focus will be very much on how we utilize a technique to identify a high probability direction to be focusing in the market. And in the next 2 weeks, in the next segment, I'll be sharing with you the setup, right? How do we identify when to get in, when to get out, how do we place our stops and entry, right? So I want to give you an overview first, since this is gonna be the first part of it, and of course some housekeeping to go through before we jump into the content. So first thing first, of course, disclaimer. The things that I'm covering over here solely based on educational purposes. They do not directly translate to any sort of a financial advice. Okay, this is how I trade the market. It doesn't necessarily mean that it's gonna work for everyone, because I can't take into account your personal risk tolerance, your risk appetite, etc. Right. So with that said, I'm gonna give you, as I mentioned, an overview of the framework. Okay, so you have a clarity in terms of how we're gonna approach the market. So this framework over here is called the DSC framework. Okay, and basically I break it down into three core components. And based on my personal experience after trading the markets for more than, I would say, 10 years, I started back in June 2012. I realized that there are certain elements in the market that are essential no matter what method or what strategy you're going to be using. Okay, and this is where I call it the DSC framework. The D behind this framework stands for direction. So what is it? All right. Basically, direction is something that as a trader you need to be able to identify, and I call it directional bias. Okay. Now there are many ways in which we can actually identify directional bias. Right. We can use the macro fundamental. Right. So in this case here, going into Q4 this year, going into next year itself, the macro and the fundamental can play out very, very easily. Okay, if you've been following actively in the market, you know that the Bank of Japan has been hiking rates. Okay, we have a very high probability the Fed will be cutting rates. Okay, whether is it going to be next month or is it going to be going into the next year, there's a very high possibility the Fed will cut rate. Right, so when Bank of Japan is going to hike rates and the Fed is going to cut rates, then fundamentally we have a clear sense of direction where the dollar yen currency pair will go. Same thing from a macro perspective. If there is a fear of recession and the Fed would eventually step in and cut rates going into easing policy, then on the stock market perspective, the directional bias can be very, very clear. Right? So we can identify directional bias using one of this method here called macro fundamental. And we can also use the technical aspect to identify direction bias, right? We can use price action, we can use chart patterns, we can use technical indicators, right? So there are many ways in which we can look to identify it, right? And if you are doing more of a short-term trading, sentiment plays a part too, right? So if today you're looking at suddenly there is a war outbreak, right? Or suddenly there's a huge market disruption, where it creates chaos, it creates uncertainty. Certain movement in the market is going to be expected, right? So that's what we call direction bias. Okay, so essentially you need to understand, right? As a trader, one of the very important element to contribute to a winning trade is to identify where the market will be heading in the future. We call this directional bias. Okay, today if you go into a trade, you go into a market, and then you have no idea where is the market heading towards, you have no technique to help you identify the higher probability direction, then you're basically gambling, right? You're basically guessing, right? So we need a method, we need a technique to help us establish what I call directional bars, which is the core focus of today's session, right? Now, once you identify the direction, obviously it's not enough, right? Because if today you can only identify the direction, then when do you get in? Which price do you get in, right? So that's also very important. Right? So that's where we have the second component in our framework, and I called it the setup, right? So what's the setup, right? Setup is basically the element of time. When to get in, when to get out, which price to get in, which price to get out, right? So setup over here, it contributes from the perspective of having a trading strategy. Okay, so a strategy essentially is like a trade plan, telling yourself, under what conditions, what criteria it needs to be fulfilled before you pull the trigger and get involved in the trade. Okay, so that's what we call a setup. That's what we call a strategy. Now, same thing here. You can have multiple strategies telling you when and where to get in, right? Some traders would use technical indicators, right? Some traders would use breakout technique. Some traders would use Fibonacci. Again, a strategy itself can have a lot of variations. Okay. Today we are looking at shorter term intraday perspective. Then obviously the sessions play an important role. Okay, are you looking at Asian market? Are you looking at Europe, UK market, or are you looking at the US market, right? So again, sessions play an important role if you are more of a short-term trader. Timing, okay, very, very crucial. Okay, and last but not least, if you're in the equities market, seasonality plays a crucial role too, right? So recently, if you're following on the index, the US market, it did a massive correction, right? Now, a lot of people may be, maybe surprised, maybe shocked, like, why suddenly the market actually came down so aggressively. Now, if you have the lens and the perspective of seasonality, you will actually realize that, oh, actually in the month of August, there's a good odd the market will come down. Right, so the timing here in terms of like which specific month can contribute to the insights that you use for trading as well, right? And that's what we call setup seasonality, right? Now, once you have the direction established, when you have the setup that you know specifically what are the conditions for you to pull a trigger, you want to add layers of confluences, right? You want to add additional factors that align with the direction you're trading, align with the setup you're looking at to increase the odds of winning. Okay, and that's where I put the last component called C, context, right? Where is this trade taking place? Okay, is it at a significant high? Is it at a significant low? Is it during a Asian market where the things are not moving and things like that, right? Basically, you need more layers to your trade to give you a high odds, right? And I call this confluences. Okay, are there different perspectives that aligns with the trade that you want to take, right? So we talk about multi-time frame as well. Higher time frame to lower time frame. Are all these time frames aligned in terms of the direction, in terms of the setup confluences, right? And of course, we also need to assess the risk. Okay, is this trade worth taking? Okay, I mean, not all setup you want to be taking in because some of it will be highly convicted, right? Meaning you're very, very confident in it. The potential profit is there by all means, right? And then, of course, there are certain trades that you might feel a little bit uncertain. The risk-reward ratio may not be very, very attractive. Then you may want to skip on those trades, right? So this framework kind of gives you a bird's eye view, a broad picture of what are the important elements you need in your trading processes, okay? In your trading processes. Today, if you realize that in your journey of trading, if you're always getting the direction wrong, then okay, you need to work on the technique on establishing your direction bars. If you realize that, I can get the direction pretty okay, most of the time I get it correct, but you are not able to get in on the trade and make money out of it. Okay, then what is that? That's actually your setup. Okay, because you can get the direction right doesn't mean you're gonna make money, right? You need to know when to get in, when to get out in order for you to realize your profits. Okay, so setup then carries that component, right? So with this framework, you get that clarity in terms of in your personal journey of trading, which element you need to work on. Okay, and that's something I would love for you guys to be aware as well, right? To give you that clarity as I mentioned. Okay, so today's focus will be very much on direction. Next 2 weeks, right, we're gonna have a second part of the webinar. That's where we're gonna talk about the setup, right? This month itself will be covering these two elements: direction plus the setup. Cool. So with that said, okay, as we are progressing in today's session, if you have any questions that you're not familiar with, do utilize the YouTube chat. Type in your question. I'll be able to look at them and answer your questions accordingly as well. But of course, we'll also have a Q&A at the end. Okay, but as we are progressing, if there are certain things that questions that pop up, okay, just feel free to type it into the chat. Okay, so I do see Chiar here, in joining us, right? Evening as well. So for all of you who have any questions, just drop it into the chat. Okay, good. So let's talk about directional bias. Okay, I did briefly mention about using macro and fundamentals, right? So certain times in the market, we're gonna get very, very clear fundamental direction. Like going into Q4, going into 2025, we'll have a very clear fundamental, right? Because we have very nice central bank monetary policy that are diverging. Okay, what I mean by that is one of the banks, which is Bank of Japan, is tightening, and then most of the other banks, they're basically cutting rates. Okay, moving forward. So when one is hiking and one is cutting, then we get a very clear fundamental bias, right? In other words, you want to be focusing on the yen strengthening in the future, and then the rest of it relative to the yen will be weakening. Okay, so that gives you a very clear direction. But today, if you're more of a shorter term trader, then the technical analysis will be more important. Right? And for me, I focus a lot on technical analysis to help me establish the direction that I want to focus, because I'm not really kind of like trading the long term, right? I'm more of a swing trader. I'm more of a kind of like mid-week kind, right? Which means I take a trade. Most of the trades on average last about like 2 to 3 days. Sometimes it can be a little bit longer, but those are the duration in which I take trades, right? So technical analysis plays a very important role. Right? So with technical analysis, I want to introduce you to a principle of impulse and correction. Right? So this principle itself comes from the Elliott wave theory. Right? Now, for those of you who are very new to Elliott wave, it's a very, very powerful technique to do forecasting. Okay, a lot of technical indicators, they are a little bit on the lagging component, and you need to be kind of like reactive, right? You need to wait for an indicator to maybe, for example, cross over before you are able to take certain action, right? So you are very reactive to the market. You need to wait for that sign and then very quickly react to it, right? You are not able to prepare forward. Okay, so a lot of technical indicators, they are lagging in that sense. But Elliott wave itself allow us to have the ability to do forecasting, which means we can prepare and plan ahead depending on various situations and scenarios the market will develop. Okay, and that's a very powerful technique, right? Because you can plan ahead mentally, psychologically, trading becomes very easy. Right? So based on that principle itself, it can get very, very sophisticated, but today I'm going to break it down into simple, understandable kind of concept that you can actually take away from today's session and immediately apply into your market going into next week. So over here, while we want to establish a direction, we basically, in the market, we have two types of movement, right? One is a continuation pattern, a continuation movement, which means previously the market is going up. There's a good chance it will continue to go up. That's what we call a continuation pattern. And then there's some times where at some point in time the market would likely reverse, right? So it will be like eventually going up, and then right now it decides to come down. So what we need as traders is basically just to identify, is the market going to continue in its current direction, or is it going to reverse? Because if it's not going to be continuing, then there's a good chance it's going to reverse. Okay? Because the market eventually can only go up or down. Okay? Or, of course, sideways. But you get my point. Right? So as a trader, you need to study, or I would say in your technique to identify direction, you need to at least have this tool. Whether is it going to continue or is it going to reverse, right? So continuation pattern over here, we have this principle called impulse correction. And in a reversal pattern, we call it a crawl. I'll show you how it looks like. Okay, but I don't want you to overcomplicate it. Keep things simple. Right, so let's take a look at the continuation pattern first, right? What is an impulse? What is a correction? So over here you can see impulse refers to when the market gives us a very strong momentum move. Okay? It can be going up impulsive, it can be coming down impulsive, right? The direction doesn't really matter at this point in time, but what you want to identify is if the market is moving fast, a lot of momentum, we say the market is impulsive in nature, right? Now, if the market is not moving fast, for example, this pullback here, you can see it's coming down, but it's going up, coming down, going up, coming down, going up, coming down. It's choppy, right? That kind of movement, we call it corrective, right? Or we call it correction. It's basically slow. It takes a longer time to develop. It doesn't move very fast. Those are what we call corrective move, right? Correction. So corrective move can be slanting to the downside. It can be slanting to the upside. It doesn't matter. Again, we are identifying whether the market is slow or fast. If it's a fast move, it's an impulsive move. If it's a slow move, it's a corrective move. Okay, that's a very, very powerful concept that you need to be very, very clear on. Okay, and then at the end of the day, the market can either develop as an impulsive or a corrective, because if it's not moving fast, then it's moving slow. There's no third option. It's either fast or it's going to be slow. So once you're able to see the market in this perspective, you start to realize that, oh, it's actually not too difficult. Okay, what you need to then now establish is, if today you get an impulsive move to the upside plus a corrective pullback, okay, this kind of combination, there's a 70 to 80% chance the market would likely go higher. What does it mean? You have established a direction that you can focus on. Because if you see this pattern, there's a good chance, high probability the market will go up. If you see this pattern on the right, impulsive move to the downside, corrective move to the upside, there's a very high chance the market will come down. Very simple. Let me show you more example of how the patterns play out. Look at this example, right? Initially, the market went up fast. Impulse. Comes down correctively. Slow move. Doesn't come down very fast. You can see up, down, up, down, up, down. What happened next? The market actually follows the previous direction. It's a trend continuation. So what does it happen? The market continues going higher. Impulsive, right? Followed by correction. Slow move. Again, this combination of impulse, correction, what happened next? The market go higher. So you can start to identify the pattern, right? When we get an impulse followed by a correction, it tends to follow the previous direction. We have a clear sense of where the market would likely head towards, right? So that's a high probability projection. Give your opposite side of things, okay? The market came down fast, followed by correction. What happened next? The market actually came down fast, right? Then does a small correction, it continued to come down. It does a correction, it continued to go lower. So it's a progressive and repetitive pattern. When we see an impulse followed by correction, we can start to project the next direction. Okay, high probability directional bias that we can start to focus on. Now, what does it mean to you as a trader? Okay, today you open up a chart, you look at the price development. Okay, for example, in this case, if you see something like that, what would you be looking at, right? Which direction do you want to be focusing on? Very clear. We have a fast move up with a corrective move to the downside. Impulse plus correction. Very clear pattern, right? Just now, if I illustrate to you like multiple examples of this pattern itself, which direction do you want to focus? Very clear. You get an impulse, we get a correction. We are projecting upside. High probability directional bias is bullish upside. So as a trader, right, when I see a pattern like that, it becomes so clear that I know I'm only interested in buy trades opportunity. I'm not interested in selling this. I'm only interested to see, okay, can I get involved in the buy? Why? Because I know there's a high probability the market will eventually go higher. Okay? So with that high probability, it builds in that confidence, and it also let me focus in the direction to take a trade. Okay, so this one definitely I'm going to be focusing on buy. Okay, and this is the example of what happens in the next, right? So we get an impulsive move, get a correction, the market push higher from there. Right? Now, give you a more example, right? In this case here, you can see the market, develops in this pattern. Which direction do you think it would likely develop next, right? Which directional bias would you focus? Okay, so same thing, right? You see this coming down, impulsive in nature, right? With momentum, it comes down pretty fast. What's next? The market does a correction. It starts to go up, down, up, down, up, down. It doesn't really go anywhere. It's slow. We are familiar with this pattern. Fast move down, slow move correction to the sides or to the upside. Not really fast. The direction we're gonna focus outside. Okay. So why again this is important? Because today if you look at a chart, doesn't matter what time frame, doesn't matter what instrument, the first step in your analysis process is to determine and establish a direction that you want to be focusing on. And you can't go into a trade thinking about buy and sell, and then not being clear which is a high probability direction. Because today if I can identify this pattern, I can identify and say, now there's a very high chance the market would go lower. I would establish a sell directional bias. Then I'd be very clear and say any buy setup, I will ignore it. It's not high probability. Any sell trade potential, I would want to focus on that because that's the high probability direction. Okay, so you can see why direction is so important. Okay, that's the first step in our analysis to establish, do I have a clear sense of direction I can look into? Okay, so what happened? The market actually came lower. Okay, again, not difficult. Let me bring you over to a real life market, okay, and show you some of the live charts over here. But of course, it's the weekend. Okay, the market is now not really moving, but I'll show you some examples on it. Okay, so I'll take examples on any instrument, right? I'll show you a couple of different ones ranging from currencies to commodities, even to index. Okay, you can see all the patterns being applied. Now, time frame doesn't really matter, but for just simplistic example, I'm just gonna stick to one time frame, the H4. Okay, now I want you to just identify certain patterns that are gonna be pretty straightforward. Okay, of course, it does take some time for you to practice and be familiar with, but once you get a hang of it, it's gonna be super easy. Okay, now take a look at this, right? If you ask yourself this up move, okay, always just ask yourself that question: fast or slow? It's straightforward, right? This is basically a very strong move. The market is pulling back. Now ask yourself, is this pullback so far developing fast or slow? Okay, I mean, you just do a simple comparison, right? This move versus this move is slow. So when you have a combination of an impulse plus correction, what is the direction do you think it would likely happen? If you ask me, upside. Okay, what does it mean? It means that I will be only interested to look out for buy opportunity. I'm not interested in selling this. But does it mean I'm gonna buy it right now immediately? No. Okay, that's where the setup will come later. But at least for now, my first step is very clear. I have a clear directional bias I can be focusing on, right? It gives you that clarity when you're trading. Okay, give you an example on gold, right? XAU. Okay, take a look at this. Okay, now sometimes you need to zoom out a little bit to give yourself a little bit more clarity. Okay, that's where I say it takes a little bit of practice. Ask yourself this question, right? Now, if you're comparing the smaller moves, like this move is obviously fast, this move up is obviously fast, this move down is also obviously fast, right? One simple technique I can give you guys in terms of the tips, turn it into a line chart if things gets a little bit complex for you, right? It can actually be so clear on the line chart, right? You can see this line is fast, right? I mean, nobody would argue about that. That line to the downside is fast, okay? The gradient of how the price drop is fast, okay? However, if you look at it from a perspective of, all right, I'm gonna be comparing, okay, let me maybe just change, if I can, change the color a little bit. Okay. So, for example, if today I do a little bit of a relative comparison, okay, I'm taking from this low to this move up, and then you start to realize, oh, what the market has been doing is that it's been consolidating. It's going up, coming down, going up, coming down. But if you compare to this move here, what is this one? Okay, that's a corrective move. Okay, it's not really going very, very fast. It's just bouncing up and down, and it's trapped within the range. Relative to this move up, what do we have? We have a combination of an impulse correction. This pattern becomes, again, familiar, right? So when we have this, what is the direction that we're going to be focused? Eventually upside. Again, I'm not saying that you're going to be buying it immediately, but then from this perspective, from this time frame, you get the idea which direction you want to be focusing. Upside. Okay, so again, you can see how simple patterns starts to establish a clear direction of bias. Give you another one, S&P. Okay, this is index, right? So we kind of apply it across various asset classes as well, right? Same question you want to always ask yourself is, how did the market develop? Was it fast or was it slow, right? So if you take a look at S&P, recently the market came down very fast. What is this? Seems like it's a little bit, corrective in nature, right? It's trying to bounce higher, but it's not going very fast. What is the directional bias to focus? Potentially still downside. You get a hang of it, right? So does it mean that it's going to keep dropping all the way? No. Okay, it just means that right now, based on this condition that I'm looking at, the direction I want to focus is sell. Which means I'm not so keen in buying it. But then again, I want to repeat this. It doesn't mean you're going to sell it now. That's where the setup comes in. We're going to discuss on that in the next webinar. But the key objective I want everyone to be able to achieve today is to establish your directional bias. Okay, the direction that you want to be focusing in taking trades. Alright, so that's one pattern. Okay, this is what we call a impulse correction combination. Right, when you see this on the chart, direction bias is clear. Now, the other pattern you want to be familiar with is the crawl. Okay, so what's a crawl pattern? If you look at this combination, initially the price went up fast with momentum. And then at some point in time, you start to realize, oh, it starts to struggle, right? It starts to lose momentum. It starts to lose energy as it continues to go higher. And then whenever we see a pattern like that, there's a high possibility the market will eventually U-turn. So it's a reversal pattern. Same thing here. The market came down initially very fast, impulsive. Then it starts to slow down. Okay? It starts to struggle as it continues to go lower. So what does it mean? It's a reversal pattern. Okay, there's a very high probability price will reverse. So again, it gives you that sense of direction to focus, right? Give you an example. Look at this, like this chart, right? Impulse move, initially very fast, and then it continued to go higher, but it goes slower and slower and slower and slower. It tells you there's a very high possibility the market will reverse. It came down, it forms a correction, we get an impulse correction, great. Continuation. Can see that, right? So that's how the market tends to develop. Okay, whenever you see a crawl, it gives you that sense of direction, right? So when you see a crawl that looks like that, right? Impulsive drop to the downside, a crawl to the downside. What do you think I'll be focusing? I'll be focusing on the upside. I'll be more interested to see, can I get a reversal trade? Can I buy it instead of selling it, right? Would I buy it immediately? No, that's where the setup comes in. But at least, again, back to the direction side, you get the clarity in terms of which direction to be focusing, okay? Now, how do you apply this, right? Today, if you look at the chart, same process, same question. Ask yourself this: how is the price developing? Fast or slow, right? So if you take a look, how did the market came down? Slow, right? It came down, going up, coming down, going up, coming down, going up. We call this ding dong, right? It doesn't really move with decisiveness. Right? Compared to what? Compared to this move here, you can see this is super clear, coming down very fast, right? So what we have an impulse crawl. Understand, right? So when we see something like that, what do you think the direction I'll be focusing? I'll not be keen in selling it anymore. The direction I want to be focusing here is going to be bullish, which means if I have a sell set up, I'll not take it. If there's a buy potential, I'll be interested in that, right? So that's what directional bias means. Okay, so we can streamline and be focused in knowing which trade to be looking at, which trade we just avoid. Okay, so what happened? The market actually reversed from there, right? Very high probability setups, right? Very high probability direction. Same thing over here, right? Certain charts are going to be a little bit clearer as well. You look at this. How did the market came up? Down, up, down, up, down, up. Very slow. Initially, fast. So that's a crawl. When I see this again, you know, okay, the direction here, I'm not going to be interested in buying it anymore. I'll be more interested in selling it. Okay, why? Because this pattern tells me that there's very high probability the market would likely come down. That's what happened. Okay. So today again, right, if I jump into the charts and start to show you some examples, right, let's go to a lower time frame. Okay, so you can play around with multiple time frames, right? Take a look at this. Right, if you need to practice this, sometimes it's easier to use a line chart, right? Because sometimes on candlestick things can get a little bit confusing. To simplify your visual, use a line chart to practice. Okay, same thing, right? Ask yourself this question: how did price reach where it is right now, right? The market is here. How did it come? It went up, down, up, down, up. This is slow, 100%. Previously, impulse move. What is this pattern that's telling me? Crawl, fast move up, slow move up. What is the direction that will likely develop in the future? Downside. Okay? Nothing complex. No need of any, complex, sophisticated indicator. We are just talking about how prices are developing based on those patterns. So what does it mean? It means that if today I'm looking at this chart, which is the S&P 500, we are looking at a 30-minute time frame. It's pretty short term. I'm not interested in buying it anymore. Okay, because why? There's a high possibility this will actually come down. So I'm more interested to see if I get a sell setup. I'll be more interested to take it. Okay, does it mean I'm going to sell it now? No, I need a setup. But I have a clear direction I can be focused and follow that, right? Same thing. If today we go to gold, what is this pattern? Ask yourself that question. How did price reach this point? Fast or slow? This is obviously slow, right? It's struggling, going up. Initially, it goes up fast. Impulse crawl. What is the direction that I'll be focusing? Reversal. Down. Okay, so if That's a buy trade. Would I take it? No, because it's not a high directional probability. Okay. So direction bias is actually very important for a trader because you need to know which side to be focusing, right? So you can filter off the other side, then be focused and then look for the setup, which again, we'll discuss more for setup next webinar. Okay. Euro dollar. Okay, so I'm just giving you multiple asset classes. Okay. Euro dollar. Look at this. Okay. This is fast. Okay, this is a little bit slow. What do you think the market would likely do? Right, same thing here. See, fast, slow, fast, slow. There's very good odds this will continue coming down and follow that top process, right? So again, every chart you want to be able to establish that directional bias. Now I'm gonna give you some example where things are not clear. Okay, let's take a look at example like this. Okay, let me just pick one that is like very obvious, right? Take a look at this example here. Okay, now not every chart every time will give you clear directional bias, right? Sometimes we don't have a pattern, we don't have a directional bias. What do? We stay neutral. Okay, so if we don't have a directional bias, we want to be patient, we want to stay neutral and wait for the market to give us a clear direction before we take it. In other words, if things are neutral, we don't trade. As simple as that. Okay, so why is this neutral? Because if you ask yourself again the same question, how did price reach this point? It came from this low, it went up pretty fast. Why? Because if I'm comparing this down move, this up move is more or less the same. This is a V-shaped formation. When we have just an impulsive move like this, right? So if you take a look at this is an impulsive move. If we only have an impulsive move, we don't have a clear pattern. When there's no clear pattern, we don't have a directional bias. When we don't have a directional bias, we don't take a trade. You can see that thought process, you can see that logic, right? Okay. I'll give you a more example, right? Let's just scroll through a little bit. This is here. How did the market came down? Fast. Do we have a pattern? Do we have an impulse correction? No. What do we do here? We stay patient, we stay neutral. Okay? So not every chart, every time would give you a directional bias. But what you want as a trader to establish is look out for those charts that give you clear directional bias. Then you focus on that, and I'll teach you how to identify the setup in the next webinar, and then you combine with it, you have a clear direction you focus, a high probability direction to focus, and then you have the setup that allows you to take the trade. Okay, you want those two coming together. Hopefully, so far so good. Okay, so again, this can be applied on anything, right? If today you want to look into Bitcoin, right? Let's say on a 4-hour time frame, what do we have? How did price reach this point? From this low, it came out pretty fast. What do you do now? Nothing. Absolutely nothing. You don't have a directional bias. However, what you can start doing now is plan ahead. Okay, we call this forecasting, scenario planning. We have this as impulse. We play the what we call if-then thought process. Okay, this is very important principle in trading as well, if-then. So what I mean by that is, ask yourself, if the market gives me a correction, okay, if the market does a correction, then I have a clear bias. The direction is up. And follow that. If then. If I get a correction here, I have a pattern. Impulse, correction, high probability upside. Focus on the buy. If then. If the market gives me a crawl, then I'll be focusing on the reversal. If then, right? Why? Crawl. Look at this. Impulse, crawl. Very clear. Impulse, correction, downside. Okay? So if then. Okay? Now, if, again, same thing, if the market comes down fast, this is a V shape, then I don't do anything. Okay. Now, this is gonna be very powerful because you're gonna be realizing the market can either go up slow, okay, or it can go up fast, or it can come down slow, or it can come down fast. Basically, 90% of the time, either of this will be how the price is developing. In other words, you just need to prepare and forecast just a couple of different situations, right? If then thought process. So over here, okay, what I've done is that I'm showing you if the market comes down slow, we have an upside. So this scenario 1, okay? If the market goes up slow, we have a crawl. We'll be focusing on downside. This is scenario 2. If then thought process. If the market decides to just come back down very fast, we do nothing. This is what? Scenario 3. What other ways the market can develop? That's it, right? Because it's either going to go up slow, or because it already goes up fast, right? So the next move here is going to be slow, right? Or it can come down slow, or it can come down fast. That's about 90% of the time, that's how the market is going to develop. And once you're able to understand all these things that I've covered so far, you realize that establishing a directional bias in the market using these principles is not really difficult. Okay, obviously it takes practice, but it's not difficult. Okay, so I hope up to this point, you're able to take away something, right? It's a very simple thing, but it's a very powerful technique. Okay, understanding impulse, understanding correction, it starts to build up into a technique and ability where you can use this simple knowledge to establish your directional bias, the direction that you want to be focusing on, because that's the high probability direction. So far so good. Yeah. So I hope while I hope that today's session gives you that clarity. Okay. We haven't really covered everything because the next session we'll be talking about is setup, and then we can start to put things together. But I really want to break it down into two components because you need to gain that confidence in establishing your direction before you go into the setup and take a trade. If today you can't establish your high probability direction, then there's no need to take a trade, right? Because you'll be guessing, you'll be gambling. So you need to first establish the high probability direction, and that's the objective that we want to cover today. Okay. Now, with all that said, right, before I jump into Q&A and see if you guys have any question, I just want to very quickly cover that today's session over here, okay, is actually supported by PXBT. Okay, so right now they are also having a little bit of a promotion offer. I'll just very quickly touch on this. For those of you who are keen to try it out, do feel free to do that. They do have a support team as well. You can of course write into them if you need any support. But I'm going to cover a little bit in terms of the promotion offer that they have at this moment. Okay, I do see Novel's question. Give me some time. After I explain this, I'll get back to the question and answer it. So currently PXBT, they're fairly new. Okay, so of course if you like to try out their spreads, their trading parameters, they're running a 0% commission. At the same time, they're running a deposit bonus right now. The deposit bonus you see over here is basically if you put in between $100 to $500, basically anything below $500, you get a 50% deposit bonus, right? For calculation purposes, the example is if you put in $100, you're gonna get $50 bonus. So in total, you're gonna have like 150 that you can trade. Okay, of course, if your funding is above 500, then you don't get 50, you only get 30%. Now, on top of that, for this month itself, because they would like to encourage more traders to go and test out the platform, give them a little bit of feedback, they are doing a kind of rebate back to you, right? Which means today you open an account, you get your account verified, you fund just $20, right? Just to test out. Okay. Once you have your account set up and you funded a $20 into your account, write into them, okay, let them know your MT5 or MT4 account ID as well as your bank details. They will refund you the $20 directly back into your bank account. Okay, so kind of like, opening an account and they give you a $20 to test out the platform. Okay, and then after that, whatever you like, whatever you think that can be improved, you can feedback over to them. Okay, so kind of like they pay you $20 to just go and test out to get that feedback, right? So right now they're running that current promotion. Okay, so again, for those of you who just like to test out a different platform, feel free to do it. Okay, I have this QR code over here, so you can actually scan it. It will lead you directly to a sign up page. Okay, kind of forget to put in the person's contact for support, but in a while I'll add it into my YouTube description in this stream. For those of you interested to get in touch with the person to have some kind of support, or if you need any questions, you can find out in the description later on. Okay, very quickly also to let you know the details of the second webinar first, then I'll again get back to Noel's question. The second webinar over here, which we're going to talk about the setup. Okay, it's going to happen on the 24th of August. Okay, not next Saturday, the following Saturday. Okay, timing here is also 9 p.m. So do take note, right? So it's a continuation because today we talk about direction, how to establish it. Then next week, we're going to talk about when to get in, how to get in, where to put your stops, where to put your target, where to put your entry. Okay, so that two components will come in together to give you the direction plus the timing. Okay, good. So hopefully that's clear. Again, if you need any more clarification about the promotion that PXBT is running, you can either drop it in the comments, right? Or those of you who have direct access to me, you can find out a bit by contacting me as well. Okay, so with that, I'll get back to Noel's question over here. The question is it possible for 30-minute chart to be opposite in the direction of the H4 time frame? The answer is yes. Okay. Let me give you an example. Okay, let me give you an example. I'll pick a obvious example, right? So that things can get a little bit clearer. I think I can use this. Good. I'll use this. Okay. So let's take a look at this, right? Again, doesn't matter what asset. Okay. Focus on the patterns first. Okay. So can H4 and M30 be giving you a different direction? The answer is yes, right? So if you take a look at this is a H4 chart. Price is here. How did it develop? Slow. Previously, fast. What is the pattern? Impulse correction. What is the direction that will likely be focusing on this chart, this time frame? So, however, today if you drop to the 30-minute time frame, what do you observe for now? We have this impulsive move. The market seems to be coming down correctively as of now. Okay, so the shorter time frame is up, but the longer time frame is down. What does it tell you? Meaning short term bullish, after that bearish. Okay, now there are some conversation where traders would say, oh, the higher time frame is more important. You focus on the higher time frame, right? Not entirely true. Because why? Think of it from another perspective. The smaller time frame would develop first before you can see it on the higher time frame. Okay. Now, what I mean is today, if you look at a 4-hour chart, it takes 4 hours to establish a data point, which is one candle. But if you're looking at 30-minute time frame, every 30 minutes it gives you one candle, one data point. Okay, so in an hour you get two 30-minute data point, right? In 4 hours you get 6. Okay, so which do you think would develop first? Obviously the smaller time frame. So the logic over here, the main general principle is if the lower time frame is suggesting high probability upside, while the higher time frame is suggesting high probability downside, usually what I'll do is I would then say, if I want to trade the short term, I need to be aware it's a very short term trade. If I want to trade the H4, which is the longer time frame, then it's telling me be patient. It's not ready to go down yet. Okay, so the multi time frame that we're doing here is what I talk about in context as well. Multi time frame alignment. If they are not in alignment, meaning we don't want to be really committing to that particular trade first. Can follow that, right? But sometimes you get alignment. For example, okay, I'll show you an example on, let's say, S&P, right? H4 time frame, we have a general direction that we want to focus down. Okay, now if you go down to the hour 30-minute, okay, what is the pattern here? It's a crawl down as well. So this gives you the alignment between 30-minute and the H4. Both directional bias is bearish. Okay, so it also gives you a sense of element of time, right? Because higher time frame is down, lower time frame is also down. Both timing suggests that, all right, the market may be ready to come down. Okay, so you can see where I'm coming from. Okay, yeah. So each time frame may be telling you different directional bias at certain point in time, but as traders, what we want is eventually an alignment. Okay, so that's really the context of things, right? Context. Okay, good. Hope that's clear. Yeah, so with that, I hope today's session has been helpful. I'm very quickly gonna flash this up again. Okay, for those of you keen, if you can't scan a QR code, you can find the link to register for your account in the YouTube description box as well. Okay, so this promotion is currently within the month of August only, where they are running, as I mentioned, you open an account, get it verified, put in a $20, okay, and get them, that means email them your ID, your MT5 or MT4 account ID, plus your personal details like your bank account. They will actually refund you that $20. Okay, so in other words, as I mentioned, they would like to gather traders to test out their platform and get feedbacks, right? And that's why they're running this current promotion. Okay, so that's all for me for today's session. Hopefully it's helpful. The next session we're going to be running here is on the 24th of August. We'll be talking about the setups, right? So mark it down in your calendar if you'd like to join us. Tomorrow on Sundays, we are also running Market Outlook. Okay, so tomorrow I'll be running a YouTube live here as well, but it's not going to be educational directly. It's more on Market Outlook. Okay, so again, you can then see how I'm applying the principles that we cover in the education webinars onto a live market environment. All right, so that's all for me. All the best for those of you who are trading for this upcoming week. If you're free, join us tomorrow. I'll share with you the outlook for the upcoming week. What are some of the opportunities I'm personally looking out for as well? And that's all. Okay, so good night, and I'll see you guys in the next session. Bye bye.